We are counting down to the December employment report. Expectations, the economy added 200,000 jobs last month, and that would be a slowdown for November, but still pretty healthy. And things could slow further as layoffs grip the tech sector. Amazon announcing it's cutting more than 18,000 workers, biggest cut ever for Amazon. So what will all of this mean for the Fed? Let's bring in Joe Lavorgna, chief economist at CNBC Nikko Securities America. He is on the fast line. Joe, what do you expect tomorrow?
A number, Sarah, around 200,000, private something less than that. The job market is certainly slowing. One of these months, I don't know if it's tomorrow, we're going to get a weak number, Sarah, because the housing market's already in recession. The index of leading economic indicators is down nearly 5% year on year. That is always associated itself with recession almost immediately. And obviously, anecdotally, we're seeing a lot of layoffs in tech, which is another leading indicator of the economy. So to me, it's just a question of when those jobs turn negative, but it is coming.
You see tech as a leading indicator of the economy? Because some people are wondering why it's not showing up. It's a small percentage of the overall workforce, right, Joe? And we've still got a tight market.
It's a small percentage, but the size really doesn't matter because what matters is it predictive of the future? And all companies spend a lot on technology. That's what they plan in their capital budget in the year ahead. If the companies are laying off workers, then clearly that inflow of order flow is slowing. You saw that yesterday, Sarah, I should say on Tuesday, with the IS component in the indicators. So yes, even though tech may account for a very small share of the workforce, it tells us a lot about where CapEx is going in the broader economy.
Hey, Joe, it's Tim. Let's talk about your view on the Fed's resolve. You're of the camp that they are going to cave, and this is a Fed that overstayed the party on the way up. Everything they've said, we just got Fed minutes. Explain why you think they will cave faster than the market and other economists think.
Yeah, so they'll cave because, Tim, they always cave. You could talk about how inflation's high and 40-year and all that stuff, but the reality is that market-based expectations and consumer-based expectations of inflation haven't moved. And when we look at the last few cycles, we find that every time the Fed talks tough, the market sort of believes them for the most part. And then when the Fed pivots, everything happens much more fast in terms of the rate cuts, and the Fed has overdone it. Look, they only got the funds rate barely above 2% back in 18 when the economy was pretty dynamic. I don't see the dynamism right now compared to then. And the Fed had a reverse and cut by 75. With a funds rate that's about half of where we are now. So this notion that somehow we're going to stay up near 5% and keep it there for this year is totally inconsistent with the historical record. And it's easy, Tim, for the Fed to be tough now and talk tough now because unemployment's 3.7. But when it goes up another 30, 40 basis points, history would say you're in recession. It's too late. The Fed will panic and they'll be cutting.
Hey, Joe, you had that graphic, or we were talking about tech, and you also said that at some point in the not-so-distant future, we are going to have a really weak print. When you think about what Amazon just announced, 18,000 job cuts, you know this. They added nearly 1 million jobs in the 3-year, in 2021 and into 2020. That's coming to a theater near you, right? Because that's just a rounding error, that 18,000 number. That's just the start.
Well, the issue is what it's a signal of going forward. And we think of everything in terms of flow, in terms of growth rates. So next year or this year, the level of corporate profits will be very high. It'll be close to a record. But the market, the equity market, is assuming it's going to grow. If it's flat or it falls slightly, that's going to enter into investors' consideration. So I don't think, again, the nominal numbers or the absolute size or ratios matter. It's more the direction of change. And housing, again, come back to that. So it's the easiest example. Housing is in free fall. We've had housing in the GDP accounts decline 6 quarters in a row. Home builder sentiment has fallen at the fastest rate in the history of the series. Housing is only 3% of the economy, but does it have a great track record predicting where the economy goes? Yes. And that's why I think the tech, anecdotally, that information is important and it's consistent with those other macro indicators I highlighted.
Joe, I'm going to push back just partly because I like arguing with you, but also, on the bearish thesis, inflation is still at 7%. They're not going to back off just because housing is weak and they get a little tick up on the unemployment rate if inflation is still so much higher. You know that the credibility on inflation and why Volcker was remembered for fighting inflation, they have to follow through with that. That is core to the Federal Reserve's independence and credibility, and they've already made a miss. So they don't want to make another miss, and that's why everything we hear from them is that we're not going to cut in 23. We've got more work to do. We don't like the easing of financial conditions, and inflation is too high.
Well, it is too high, and the Fed is talking tough. But the Fed typically is a backward indicator of consensus expectations. The markets, the slope of the yield curve, five-year forward swap rates, long-term Michigan inflation expectations. None of those metrics suggest there's any forward or future inflation problem. So my sense is that as inflation, by the way, continues to fall, I should have added that maybe a bit sooner, as inflation falls and falls very quickly relative to what the baseline is, and unemployment worsens, the Fed literally will pivot to the unemployment rate and the fact that the unemployment rate is a leading indicator, and the Fed will then backtrack and remind us, by the way, inflation's a lagging indicator. So they're talking tough now. The issue, Sarah, is does the economy go into recession this year? If it doesn't, then you're correct. If it does, you're going to see the Fed. You're going to see the Fed turn.
Joe Lavorgna, thank you very much. Always good to have you on.
Thank you.
SMBC, Nico. Guy, final word.
I love when you argue with Joe. I love Joe Lavorgna. What I will say, though, let's play it out and the Fed does pivot, you know what's going to happen? All the things that were inflationary a year ago are going to get back on their horse again, specifically the commodity market in the form of crude oil and other things. That's the problem. They think they've got it beat. They don't, because the commodity market is waiting in the wings.
Copper prices 6-month highs.
So you don't think that the Fed should blink?
No.
Disagree with Joe.
No. Yeah. For the first time in a long time, they're actually doing what they're supposed to be doing.
Yeah. All right. That's the nicest thing you've said about the Fed.